We've got the Australian market at 7% overvalued. The US even close, slightly undervalued.
I think people would be surprised to hear that the US is a tick undervalued.
I want that dividend income to grow over time, which means I need a company that makes more money, and that's shares. I want every year to be better than the last one. I think more than anything else, investing is this means to an end, right?
Hero or sidekick?
Welcome to the Sidekick podcast, where we uncover the hidden superpowers that drive some of the biggest and fastest growing companies and successful names in the business world. I'm Bryce and I'm joined by my co-host Ren, and we are your trusty sidekicks. Ren, how are you?
I'm very good, Bryce. Very excited for this episode. We're speaking to one of our favourite experts here in Australia, Mark LaMonica. Welcome to Sidekick.
Yeah, thank you for having me.
So Mark is Director of Personal Finance at Morningstar Australia. And Mark, you have plenty of tools at your fingertips over at Morningstar. So to kick off, can you give us a sense of what these tools and resources are telling you about markets as a whole, both here in Australia and the US?
Yeah, absolutely. So, when we talk about, resources at Morningstar, we're really talking about our analysts. And so we cover 1,600 shares globally. So that's all covered by a person. So sitting in our Sydney office, sitting in the US, Asia, Europe. And so really when we look at the market overall, we're doing a bottom-up analysis. So I'll give you our valuations, but our valuations are just taking the valuations we have on those 1,600 shares globally. And then obviously when we look at the Australian market, just rolling up those Australian valuations. So we don't do any top-down looking at the market, but really where we are right now is we've got the Australian market at 7% overvalued. And I know that sounds very precise. I'd probably say that falls into the ballpark of a fairly valued range. The US even close, slightly undervalued, I think 1.5%. Last time I looked. Now, obviously, this stuff fluctuates every day as prices change. But I'd say kind of both markets fall in that fairly valued range.
That's interesting.
I think people would be surprised to hear that the US is a tick undervalued. Can you give us some color on that?
Yeah, so two different ways to look at this. Number one, when our analysts are coming up with those valuations, they are doing a discounted cash flow. This is not looking at something like a price to earnings ratio. So that's number one. The other thing that I would say is when we are doing these valuations, they are equal weighted valuations. So what that means is what we've seen in both Australia and the US, we've seen the biggest shares go on pretty good runs, right? So in the US, tech shares, in Australia, the likes of CBA, but we're looking at that equal weighted. So whereas if we were looking at a valuation level of the ASX 200, that's a market cap weighted. So the biggest shares influence it more.
Do you have an idea of if you change the methodology to market cap weighted, how that would change the results?
No, I don't. Okay. but that would be an interesting view. But that's something that I think would be good to look at. The one other thing I would say is these are only shares we cover. We don't cover every share. So we don't cover the entire ASX 200 in Australia, but we cover about 190 of them. So it's close. So I guess that's the other thing to look at as well.
I think if you cover 190, you get the gist.
It's close enough. Yeah, exactly. And we do cover, obviously, the big ones.
So one thing we love about Morningstar is your assessment of not only value, but also moat, which is this hard to quantify thing about a company's sustainable competitive advantage. But you guys lean into it and try to quantify the difficult to quantify. And we want to start with the Magnificent Seven because that's top of mind for everyone. How are you thinking about these big tech companies now, both on a value perspective, but also a moat perspective?
Yeah, so I'd say it varies, and I'll go through them. There are some that we do think are good values, undervalued. I will say every single one of them does have a moat rating. Now, we have two different moat ratings. We have, and as you said, the difficult to quantify is, like anything in investing, you're predicting the future. And, looking in the past, there are a lot of ways you can figure out if a company has a moat, right? If they have higher profit margins than other companies in their industry, if the return on capital they invest in the company is significantly higher than their cost of capital. Those are all signs of moats, but of course the issue is we need to try to predict what's going to happen. So we have what we call wide moat companies. And that's something that has, our analysts believe, the moat will last for 20 years into the future. Then we have narrow moat, which is 10 years.
Just pausing on that, 10
Yeah.
years is still pretty good. 10 years
absolutely.
is a long time.
Absolutely. I'm pretty old. I may not make it another 10 years, but it is really good.
Yeah.
But really, it's their confidence, I think.
Yeah.
And obviously, those are kind of arbitrary numbers at the end of the day, but I think their confidence in how long that company can sustain that moat. And it's difficult because one of the things that really can impact sustainable competitive advantages is new technology, right? And so as, we had that freak out about NVIDIA, that this whole thesis that you need these powerful chips and it's really, really expensive to develop these AI models, like that's a case where, I think the market's walked it back, but that's a case where new technology can just destroy a moat.
Well, take us through the 7.
All right. So why don't we start? We'll start with NVIDIA. So we have a price or a fair value. So that's what we think it is worth. It's around fairly valued right now. So our fair value is $130. It's trading a little bit below. I didn't see what it did overnight, but wide moat. If we want to talk about a couple undervalued, which might be more interesting. So Alphabet.
I was going to say,
Yeah, that's the one.
So Google's parent company, of course. So we have a fair value of 237. Once again, before, and the market did drop last night. I had 170 was the price I looked at the end of last week in the U.S. Also has a wide moat.
So you think it's almost like, 40% undervalued?
Yes.
Wow.
Nice.
I mean, not me personally. I didn't come up with this, but our analysts. And one thing I guess I should say, a little bit of a caveat is where I find a lot of value, and yes, I do work at Morningstar, is reading the reports from our analysts. So I would say, listen, I'm going to go through some numbers. People can do what they want.
Yeah.
It's a business, right? And I think reading the report, whether you agree with our analysts or not, they are offering an opinion. That opinion obviously goes into that fair value. So I would encourage people to do that. So how about Meta? So also undervalued. So we have a fair value of $770.
Okay.
Wide moat again. Amazon, a little bit undervalued, so about 10%. 210 was the last price I saw it trading for at the end of last week. And then Microsoft, so about 20% undervalued. Wide moat once again, so the fair value is 490. It's trading around 400.
Wow.
Last time I saw it. And then we've got a couple we think are overvalued.
Okay.
So Tesla. Yeah, so
even after falling 40%.
I know. We have not. I can offer my own opinion on Tesla, but I think for a while we thought the market got ahead of itself with Tesla. So we've got a fair value of 250. It's trading at 290 last time I saw it. We give it a narrow moat rating. And then Apple, so biggest company in the U.S. So we think it's about 20% overvalued. So a fair value of 200. It's trading at about 240. That also has a wide moat. So that's our view. Differing views, and I know everything gets lumped together, but these are different companies.
Yeah.
And in some cases, very different. Like Tesla, I get that it has a technology component, but they make cars.
Yeah.
And that's very different than the business model in something like Microsoft. Very different companies.
Yeah, love that.
Yeah.
Love that. Now, Mark, I should point out here that if anyone is interested, you do actually have the Morningstar Wide Moat or the VanEck Morningstar Wide Moat ETF, which you can go and have a look and get more information on that. It's actually going to be available through Superhero as well. But let's turn our attention to Australia. How are the large companies in Australia faring from a valuation point of view? Of course, we've got the big banks and the miners.
Yeah, and if we look at last year, going in opposite directions, right? So big run with the banks, miners did have a pretty poor year. So let's start with the banks. CBA, which, if you consume any content, people just talk about
Most
CBA.
expensive company in the world.
Yeah, exactly. So
Morningstar might be undervalued though.
no. So CBA, we've got it 60% overvalued.
Wow.
Okay.
At this point. And then in terms of Westpac NAB, 10% overvalued, and ANZ fairly valued. So all of them have wide moats, basically for the same reason. There is obviously the big four banks and then kind of everybody else, and they have cost advantages both through sort of spreading those fixed costs that you have running a bank over a much wider customer base, and they get cheaper funding. And then also switching costs. Nobody wants to switch their bank. I actually recently did it, and it's a pain. And so nobody wants to do that. So they all have those wide moats, but very big difference in valuation between those.
Wow.
Yeah, CBA.
Yeah,
What about-
I mean,
yeah.
it's crazy.
But look, fundies have been saying it's crazy for about 18 months, and it just keeps on keeping on. So
I know.
well, let's use that as a segue to the miners. How are you seeing them?
Yeah, absolutely. And I will say our analysts obviously aren't always right because they are predicting the future. I think they've done a really good job with the miners. We've sat there for years now and said iron ore was going to fall in price. And, if you look at iron ore right now, so it's trading a little above $100 US per ton. We've got a price of 72 by 2029. And so really, for years, we were saying the miners were overvalued. They've all, if we look at Fortescue, BHP, and Rio, so they're all in that fairly valued range coming down. So we still don't think they're cheap. Obviously, there's a lot going on with them. Iron ore is the big one, but they're all trying to diversify out of iron ore to sort of varying degrees of success. I'd say Fortescue, not very successful. Maybe the other two more successful, but yeah, it's still not. We still think China is going to continue to just reduce demand for iron ore, and we'll see that price pulling back.
Well, I guess if we're to step outside of the big seven and the companies that dominate the top of the ASX 200.
No, they're our big seven. 4 banks, 3 miners.
Exactly.
Wow. What are some of the companies coming up on the Morningstar screens that are ticking the sort of really good value, but also good quality?
What I did is I basically ran 2 different screens. I did one in Australia, one in the US, and really, and I mentioned our analyst reports before, why I think they're interesting is because basically investing success at the end of the day is there are expectations, and what you are trying to figure out as an investor, are these expectations right or wrong? The market expects something to happen. You think it's going to be better. You think it's going to be worse. That's going to drive that share price. So it's not sort of absolute. And I think that's how a lot of people think, it's just how a company performs. Well, no, it's against those expectations. So let's start with the U.S., and I'm going to start with alcohol because I don't know, I like it personally. But there's this narrative around alcohol that is very negative, and basically that consumption is dropping. And there's all sorts of different reasons for that. One, there's this generational thing that young people are drinking less. There is all the diet drugs. So they are curbing lots of cravings. So that can include, of course, excess drinking. And we have to remember that the top customers do drive a lot of consumption from an alcohol perspective. I guess that's a nice way of saying it. So we think that there's that issue. In the U.S., there's a fear that cannabis is replacing drinking. So I think more Americans use cannabis on a daily basis than drink right now. So that's certainly a fear. And then, of course, there's tariffs. That is going to hurt a lot of these alcohol companies that are big exporters. Our analysts think that, no, this is way too negative. Now, that doesn't mean that there isn't truth in this, in certain parts of this, but they really think that things have gotten way too negative. And so 2 picks from the U.S. So one is Brown-Forman. So they are the Jack Daniel's parent company. So we've got them 40% undervalued, wide moat. So I screened everything with wide moat. And really the moats with things like Brown-Forman, things like alcohol, it's brand at the end of the day. So Jack Daniel's is obviously a huge brand. So Constellation, Modelo, Corona, and they do some other stuff besides beer. And once again, it's really brand, that moats around brand. We think that's about 40% undervalued as well. Wow. So those are 2 picks in the U.S., wide moat, significantly undervalued, that people might be interested in. And I think one of the reasons I really like consumer shares is because, we're not trying to assess a chip that NVIDIA is making against, AMD or something like that. You can think about your own life, whiskey. Think about, exactly. Yeah. Go to the pub, experiment with some different whiskeys, see what happens. But it's something that's easier for people, I think, to think about those narratives and whether that's true.
Nice. Love that.
And then I've got another one, Nike. So
controversial.
Nike's gone through all sorts of problems. So this is really, I guess, a turnaround story more than anything else. And I think, this is a case where, rather than the negativity around drinking overall and the different companies getting caught up in this is just negativity around Nike. A couple things that they've done is, they've alienated a lot of the wholesalers that sell Nike gear, and they've done this kind of direct-to-consumer thing where they focused a lot on Nike-branded stores. Well, unsurprisingly, that upset all the other people that were selling Nike, athletic gear, shoes, everything else. So that's one thing. The other thing is, because of all this and this kind of lack of focus, competitors have picked up. So we've heard about some of the new entrants in the market, of course, but basically they're just chipping away at Nike's market share. And then somehow, despite what I see walking around the street and the fact that nobody wears real clothes anymore, apparently there's been this drop in sportswear globally, which is strange. Yeah, exactly. Not where I live. But so all of these things have really hurt Nike. They have a new CEO, a guy by the name of Elliott Hill. He was a longtime executive at Nike. He's back. Our analyst likes the plan they put together and thinks that demand will pick up in general. So Nike, and I'm not just picking things 40% undervalued. I promise this is a coincidence, but once again undervalued and wide moat again, once again for the brand.
Yeah.
So those are 3 U.S. picks.
Love that. Yeah, we've spoken about Nike before, and certainly one that I think we both have a close eye on at the moment, given what it could become. What about on the Aussie side?
Okay, so once again, this was not one of the ones I was going to talk about, but Endeavor, kind of the same thing happening with some of the issues around drinking. So something to think about there. We do have a wide moat on that one as well. The 2 that I picked, Brambles.
Yeah.
Now, Brambles is boring. Right. So for people that don't know, no.
I was going to defend it not being boring, but explain what it is.
I'll tell you why I think it's boring, and then you can tell me what I'm missing. So, at the end of the day, Brambles makes pallets that you ship consumer goods in. I think that's a little bit of a boring business. I don't know.
I think Brambles and Shep pallets are the best real-world network effect in the world. They make global logistics work. Well, at least Australian logistics, because you don't get into different pallet sizes in different countries. But the idea that you can ship something from a warehouse onto a truck, onto a train, onto another truck, into another warehouse, eventually onto a shop floor, is only enabled by these blue pallets and red if you look at Loscombe as well. But it is just it's the beauty that underpins our global logistics.
Ren loves pallets.
Yeah. Let's just say we have different interests. All right. So while I'm in the pub trying to think about demand for different liquor, you're, I guess, at the airport, watching things get loaded on the train.
This Nike story that you want to play out, it requires pallets.
Okay. There we go.
But we can take this argument offline.
Okay.
As an investment, where do you guys see it today?
Yeah, so once again, I'll leave my commentary on the excitement of the business aside. We think it has a wide moat. We think it has a big cost advantage over any of its competitors. And really, as it goes into different markets, and the different markets that it is in, it has a dominant market share. And it has this cost advantage. And I guess other than you, nobody cares about which pallets they're using. They're going to go with the cheapest ones. So they've really built that through scale. And they have, and if we think about a business, you're investing money that the business makes back into the business. You're trying to earn a return that's higher than the cost of that capital, and they've done it for years. So we just think it's a really, really solid business. And it's about 15% undervalued, so not as big as the other ones, but it's hard to get great businesses really, really cheap.
Let me give you the case why people do care what pallets they use. So the beauty, I see Shep as like a dominant player in a space that makes it really hard to disrupt because everyone has a Shep account. So that supply chain that I explained earlier, you're transferring the Shep pallets to account holder as it moves through the supply chain. If I wanted to start my own pallet business, and rather than blue pallets or red pallets,
it sounds like you might want to start your own pallet business.
No, because it's impossible to disrupt. So let's say I start Ren's pallets, piece of wood, paint them green, and try and disrupt it. I have to go to every point in that logistics network and convince them all to open accounts with me for that pallet to be able to move through the supply chain. That's the beauty of their business.
Yeah.
Sold.
Yeah, exactly.
How is that not exciting? You're listening to an investing podcast. You've got to be excited by this stuff.
I mean, maybe you should rename this podcast just the Pallet. I don't know. What. You'll have to come up with a better name than I can. But,
Pallet Pals rather than Equity Mates.
Perfect. There we go.
So that was one Aussie company.
The ASX.
Wow.
Now,
Okay.
this is once again, I think, a little bit of a turnaround story, obviously. So let's talk about the ASX in general. Like, an exchange is a great business, right? So you're just this middleman that's taking a cut of all these different transactions. The ASX has a virtual monopoly on trading all sorts of different things in Australia. Now, they've taken this great business and tried to destroy it, basically. And they've done it, this very well-publicized chess replacement fiasco that has upset everyone. It's upset the regulators. It's upset all the market participants. It's certainly upset their shareholders. And a lot of bad press. We think that they're going to turn this around. So what they've done as a company, and we think that this is a good move because they have to protect that moat, right? And their moat is they have this virtual monopoly in Australia. Now, there are some competitors coming in, but they still control the vast majority of all trading. So what they've done is they've thrown money at this problem. So they've, of course, thrown money at the problem of how do we replace chess. They've thrown money, they basically thrown all this money at the market participants because they've obviously hurt them with everything that's happening and saying, hey, stick with us. And investors, of course, don't like that. We don't want the companies we own to spend money. But they're getting to a point where it's every single time they reported, the costs had gone up and up and up and up. And it's getting to a point where it looks like those costs are kind of stabilizing. So we think this is at least an opportunity that they can pull this off. And once again, turnaround play here. But I don't know. You guys seem equally passionate about the ASX as pallets.
I'll let Bryce take this one.
No. What's the numbers on it? Like, what do you have as the discount?
Yeah. So once again, wide moat, about 30% undervalued. We think obviously there's going to have to be a little patience here. But really it's thinking about this business. The business of an exchange is a great business. Our analyst that covers it, this guy Roy, will not stop talking about it. It's kind of like pallets. Will not stop talking about how great exchanges are. The question is, are they going to screw this up? And, has the damage been done, which is basically going to lead regulators and customers and everybody else to go onto a different exchange. We will see. But, really our analyst Roy, who covers it, also thinks that there's going to be a tailwind around more listings in Australia with all the rare earth stuff and everything else. And, of course, more listings hopefully benefit the ASX as long as people choose to list there. Probably a more controversial one.
I think if people want to understand how good a business exchanges can be, Intercontinental Exchange, which owns the New York Stock Exchange, up almost 86, 87% in the past 5 years. The NASDAQ itself is, the company, not the NASDAQ 100, is up over 120% in the past 5 years. These businesses, when they work. Question is, can the ASX make it work?
And we'll see. And as I said, they've been trying hard not to.
So, but I guess the leadership team that were in charge of the chess replacement project are now out. New CEO, new tech people. Down 10% in the past 5 years. Down 30% almost from its recent highs. So. Let's say. We will see. But hey, I think it's one of those things where it's really getting back to the beginning where it's kind of what are the expectations versus what's reality. And low expectations are easier to beat. The way I live my life, right? I set really, really low expectations and then see what happens. Well, Mark, that is a good segue because we want to talk about how you do live your life and in particularly how you invest to enable your life because we think it's one of the best examples of people taking their investing goals and then investing in line with it. But before we do, we're going to take a quick break to say thanks to Superhero.
This series wouldn't be possible without the support from Superhero.
Superhero Super is a low-fee, award-winning super fund. With a wide range of investment options and the flex to invest directly into ASX-listed shares, ETFs, and more, Superhero Super is primed for performance. Superhero also won the 2024 Excellent Rates and Fees and Best for Direct Investment Awards by WeMoney Superannuation.
Now remember, Superhero does not provide financial advice, so consider whether their product is right for you. Read their PDS and TMD and download the Superhero app at superhero.com.au. Interests in Superhero Super are issued by Diversa Trustees Limited as trustee of One Super. Superhero Super is a sub-plan of One Super. Welcome back to Sidekick. We are here with Mark LaMonica, Director of Personal Finance at Morningstar Australia. Now, Mark, we're going to move away from the Morningstar side of things a bit and focus on your personal investing journey, because as Ren said before the break, I think we haven't spoken to anyone who has such a clear, relationship between your personal life goals and then how that translates to your investing journey. So let's start with that. What are your personal investment goals, and then how does that translate to how you invest?
Yeah, absolutely. So, I think more than anything else, investing is this means to an end, right? So what do I want in my life? I want more experiences. And, I think if any of us, I'm not quite on my deathbed yet, but I think when people look back on their life, it's just accumulated experiences. And we all want to do different things. I love travel, I love eating, I love going to sporting events. All of this stuff is what I want more of in my life. And, I've tried to align what I'm doing from an investing perspective to that. And, the problem is, yes, there are experiences that are free, but unfortunately a lot of mine actually cost money. And I think in a lot of cases, even if it's time that people want, time to do things on their own, that all costs money because you need money not to work and give yourself more time. And so really what I've tried to do is I sat there and thought, okay, I need more money. How do I get more money? Well, I'm not quite old enough to start spending down money I've saved. So I've really taken an income strategy where I can maintain my principal, I can spend that income I make on experiences. And really what I want every year to be better than the last one. And I know we all want that, but if we're looking at things you can experience, trips you can go on, I want to do more next year than this year, and more the year after that than next year. So
nice.
I think the beauty of that, though, is you are quite deliberate about the time frame. You want the income this year or for next year, you want to set yourself up to have more next year and then the year after, rather than people having this nebulous, at some point I would like to live off passive income and be able to enjoy all the experiences. So you want income now. There are plenty of different income-paying assets out there, bonds, infrastructure. You could buy a rental property, dividend-paying stocks. Why is it that income-paying stocks, dividend-paying stocks is where you focus?
Yeah, I think it's that growth side of things. So I'm 45. I've got a little time to go. And anyone who didn't know about inflation, obviously in the last couple of years have figured it out. So prices increase over time. I want growing income. And so the same reason you want to invest in shares, even if you don't care about income, they grow their earnings over time. When prices go up, companies can raise the prices on their goods and services. They make more money. And so, I want that dividend income to grow over time, which means I need a company that makes more money, and that's shares, right? That doesn't happen in bonds. Bonds are actually terrible with inflation because most of them are fixed payments. And so really with my timeline, just like any other investor with a longer timeline, my timeline for income means I want shares. I want that income growth over time.
You could argue that does translate to investment properties, for example. So how do you think about property in the mix of things?
There's kind of two ways. There's two ways of looking at it. One, if you are buying an investment property for income, so not price appreciation, most places in Australia, you're not getting it, right? Right now. So there is no yield on that property. Now, obviously with negative gearing, you can get back to zero essentially, but there is no yield. So it's a very long-term play. You're saying, okay, well, hopefully in 10 years from now that rent does increase a lot. Rent's increasing, as a renter, I certainly know this, rent's increasing at a rate higher than inflation. So rent does go up, but it's kind of looking at that starting point. And I think everyone needs to assess income levels versus growth. But when you're starting so far underwater, it's a little bit of an issue. And I think the other issue that's probably underappreciated by investors in property that are trying to get income is, of course, there are maintenance costs and things go wrong and you have to put money into these properties. So for me, that once again makes it even more of a negative yield. That doesn't mean that you can't make a lot of money doing that. If prices appreciate anything like they have in the past, there are a lot of advantages, right? Like this is a leveraged play. The gearing involved in it makes any return on the property, makes their personal return a lot higher. There's lots of reasons to do it. It just doesn't necessarily fit in with my income strategy right now.
Which is exactly how we started this, saying like you have a really clear idea of your goals and then the assets and the strategies that both play into that and also don't play into that. I'm sure you've courted controversy over the time by saying you're never going to own property.
Yeah, I mean, just a little bit. So a couple of people in Australia like property, apparently. I don't know.
Who knew?
It's been my experience here, yeah.
But look, a lot of people watching this podcast or listening to this podcast certainly like the idea of living off passive income. I mean, I imagine it's always been a trend, but the last couple of years as rates have risen, we've certainly seen the uptick in people talking about passive income strategies. What are some of the common misconceptions around these strategies, or what are some of the common mistakes you see people make when they try and pursue a strategy like that?
Yeah, I think the biggest thing is forgetting about this growth component. So I think like simplistically what a lot of people do is they'll say, okay, I'll screen for dividend yield and I just buy the highest yielding shares. Well, like that just has not worked out well. So often the highest yielding shares, why is the yield so high? Because the price has fallen. Because investors expect that the future is not going to be that great. Now, maybe, as I said before, maybe they're wrong. You can go in there and assess that if you want. But I think just like buying the highest yields, most of the time the market's right. If not, it'd be really easy to beat, right? So most of the time the market's right. So I think going in and buying those high yields and forgetting about growth is an issue for everyone. Even if you are retiring at 65, you're likely going to live a very long time. That growth is important.
So what are some of the characteristics that you look for when choosing a good dividend company beyond just searching for highest yield?
Yeah.
That's what he doesn't do.
No, I know. Other than
that, I think it's a couple things. So the first thing I obviously do is I won't buy something that doesn't have a dividend. That should be obvious. So I think income. Then I always think, maybe I'm a pessimist, I always think like what could go wrong? So while growth is my goal, I think, okay, what about stability of that dividend? So I look for a couple different things. I'm going to say a couple Morningstar ratings in here, but I'll explain how to do that without Morningstar. But really, one, when we look at cyclicality, right? So earnings drive dividends. So you need to focus on earnings. I don't generally buy cyclical companies. Now, that knocks out all the miners, for example, in Australia. But, I want sort of steady earnings. I don't want these dips and highs and everything else, which we've seen with the dividends. You look PHP's dividend, or the one they just declared, very low a couple of years ago, very high. I don't want that. I want smooth growth. So I buy things that are non-cyclical. I look at business risk. So I think people don't think about the risk of the underlying business. We talked about pallets earlier. And yes, I described it as a boring business, but it's also pretty predictable, right, at the end of the day. And some businesses are very unpredictable. Some biotech company that needs to discover this new drug. Bigger companies are generally more predictable than small companies. They operate in more markets. They have more products. So we call that the uncertainty rating. And so what I want is low uncertainty. So I want predictable companies, predictable results, because then I can spend some time, which I'll talk about in a second, trying to figure out what's going to happen in the future. I want all of that. Companies that are in good financial shape, not a ton of debt. That can, of course, impact dividends. Then we would start looking at growth. I look at a couple things. Like one, you still have to analyze the business. So I don't need huge levels of growth, but you have to think that there is growth in this business, moats, that generally corresponds, as I said before, pricing power, right? So if we get some revenue growth and we have the ability to raise prices, like that's very good for dividends going forward. So you really have to analyze a company just like you would if you were investing for anything. I think people think that you can just ignore all of that. You just look at the yields. It's like, well, no, this is a company. You got to figure out if this company, if there's some sort of driver for it to grow.
And then when you find those opportunities, how do you think about building the portfolio? Do you just have like a few concentrated names that you're super confident in their dividend, or do you want to diversify across sort of how many names are we talking?
I think a big thing for all investors is we need a little bit of humility, right? And you can study a company for months and months and months, and anything can happen, right? Like, obviously this doesn't happen a lot, but you could have studied Enron for, years, and then turns out they're doing illegal stuff. So I think a little bit of humility. I try not to let any position, single share position, make up more than 5% of my income. And so I take that income lens on it because I try to think about, okay, what is going to derail my life? Well, it's going to derail my life if 20% of my income is coming from one share and something bad happens. And it does. I'm not proud to admit it, but I owned Intel for years and probably missed too many signs that company had fundamentally changed and competitors were basically eroding what used to be a good moat for that company. So Intel, I recently sold it, but that was after the dividend got cut. And, we can say that I'm an idiot, and I probably am, but at the same time, I don't want a mistake I make or something I don't know to sort of ruin what I want, which is that steadily growing income.
So you're obviously quite active. What are your thoughts on the yield maximizer ETFs that are out there that kind of portray themselves as, well, not portray, but are designed to maximize dividends?
I think it's an interesting one. So I talk about dividends all the time, but listen, like everyone else, I want my portfolio to go up in value. I don't necessarily think that it's a trade-off. I think that if you can find companies that are growing their dividends, they will outperform over the long term. Now, I need to be aware of what I'm doing. If I'm spending those dividends, which I am, dividends make up a big part of returns. The returns we see all include reinvested dividends. People need to be aware of that. So I'm not sitting there thinking, oh, my portfolio will grow 9% a year and I'll get all these dividends, right? So I understand that. But I still want capital appreciation in those shares, and I still think I'll get it over the long term. The problem with ETFs like that is basically they're covered call strategies. And what you're doing is you're limiting the upside. So you're making that trade-off that I am not going to have capital appreciation, but I'll get a really high yield. And they've delivered very high yields. I think there could be a point in my life I would do that. I'm not quite there yet. I guess I don't know, it's not a dream, but I still want that capital appreciation. I think at some point in my life, I would probably switch, maybe as I get into retirement. But at this point, I still want that growth.
Nice. Well, love it, Mark. Thank you so much for coming in and talking us through, I think, where we are at from a valuation point of view, US and Oz, but also sharing your investing journey. Love hearing about that. And as Ren said, I think a lot of people will take a lot out of that given their focus on income as well. So thank you so much.
Yeah, thank you for having me. I do expect to be the first guest on Pallet Pals.
Deal.
Consider it done.
Okay.
I'm going to go trademark the name now.
Well, if you're interested to learn more about how you can grow your wealth like a superhero, head to superhero.com.au.
And make sure you subscribe to Sidekick wherever you are listening or watching so you don't miss an episode. That's it from us, your trusty sidekicks. We'll be back uncovering more superpowers next episode.